Good morning. My name is Brendan Rundo. I'm with the Homes Orlando team at Next Home Neighborhood Realty. And this is my buddy, Joseph Dionne of Appli Home Loans. Morning, Joe.
Hey, good morning. How are you doing today, man?
I'm doing good. Enjoying the cool weather down here in Florida. You know?
That it is. It's fantastic weather, and I'm excited to be with you this morning. I think we've got some great stuff. So I'm curious, what are we going to dive into today?
Today, I think it's important for us to go through what the current increase in interest rates is meaning to buyers, especially with the low inventory and the continued home price increases that we're seeing.
Yeah.
And this it's a battle out there for home buyers right now. It really is. So, what have you seen in the past month alone? What have you seen as far as the increase in rates and how that's affecting our buyers?
Man, this has been such a huge talking point at my brokerage and my company between my owners and myself and our entire team is this big change in rates. And we all knew it was going to come at some point. We saw it, and we've seen the market tested a couple times. And really just from December to now, so you're talking 1 month time, we've seen a 0.5% to 0.625% increase in rates. And you're talking in 30 days, the rates have changed that much. So
that's nuts.
So
that's nuts.
What does that really mean though to a consumer? Because all right, I've got a higher rate. Like, what does that mean though, right? So
it's got to cut into their purchasing power. It really does.
It really does. So right now, if you're in Central Florida and you're looking at a house, you've got to be around 400,000, somewhere around there.
Oh, minimum these days.
So if we were to say 400,000, average buyer put in 5% down, and let's just say, so we're going to go with a loan amount of 380,000, just to give you some data real quick. So I went and I pulled some information of the average rates as reported from Mortgage News Daily for the last month. Right. And then Mortgage News Daily is an industry, it's a recognized website for mortgage rates and data and everything going on with all this fun stuff.
They give great info. They really do.
So a month ago, they were reporting rates on average were about 3.125. And then today, they're reporting those same rates are right around 3.75. So that's 0.625 difference. And this is pulling the data from major retail lenders, from brokers that are reporting data. This is everybody that's just kind of like reporting their own data of what they're offering, and it's out there, right? So you go into that, and that difference, 400,000, and let's say 400,000, 5%, 380,000 loan amount. At a 3.125, that principal and interest payment is $1,267 and change.
Okay.
So, all right, excuse me, $1,627 and change.
Okay.
Sorry. I was trying to make it really affordable for these times.
Yeah, wow, that's pretty. I was going to say,
you're like, I'm about to get
everybody on over this afternoon.
So that difference from now is at 3.75. That same loan amount would be $1,759 and change for a principal and interest payment. So that's basically. You're looking at $130 increase almost, and principal and interest payment. Where does that kind of equate? So let's say a buyer was at their top of their debt to income ratio. Like they couldn't go any higher when we were at a 3.125. That's the max that they can qualify for. So today, they wanted to buy that same, have that, and maximize their buying power. They would be down to a $370,000 purchase price.
They lost $30,000 in purchasing power in a month.
$30,000 in 1 month. Like that now that's something where, if you're watching this or you're an agent and you see this video, or you're another broker or lender out there, and you're a client specifically, if you haven't talked to the person that you're pre-approved with that in the last month, you better be having another conversation with them to make sure that you're still in good shape.
Yeah. Because they're going through, a lot of the buyers, the way they work is we've got them set up so that they get the new listings every morning.
Yep.
I'm actually joking with them. Hey, they come out at 6:00. My pants are next to my bed. You see something, call me. We're out the door. It's still that competitive. There's a lot of pockets right now. I'll give you a perfect example. Down in Davenport, which used to be 90% all vacation homes.
Yeah.
Well, it's now probably 50-50 residential vacation. So you got people competing who are moving here. You got foreign buyers who finally can get out of their country after COVID restrictions are lifted.
Yep.
And then you got Americans who want a vacation rental. Their kids are growing up a little bit. They want to be able to come down to Disney every year, maybe get that short-term rental. And 14 homes we looked at, 14 homes, all gone one day. One day. All multiple offers, 10 to 20 offers on them.
Man, you're talking like you said, that's Davenport. So that's, when you look at the metro Orlando area, like you're really on the outskirts right there. Like Davenport's almost like you're not Tampa metro, you're not Orlando metro, you're like somewhere out there.
You're somewhere out there. Well, look at Oviedo last month. I was fortunate enough to have a listing in Oviedo last month in the sanctuary. Great community, right? I was the only one. There's 900 to 1,000 homes in the sanctuary. I was the only one for sale. 36 homes in Oviedo. That was it. 32765 zip for sale last month.
So that's crazy. And so when we look at that, right, and we talk, all right, so interest rates have gone up. They've taken a big bump up, and the reality is it's extremely volatile on the market right now. But I don't see, you're not going to see, when I say it's volatile, you're not going to see tomorrow that it's 3.65 and the next day it's 3 again. No, you're going to see all right, today it's 3.625, 3.75, and, maybe it improves and it goes to 3.62. So a very, very small change down, but then that bump up might be 3.875.
Yeah.
But, kind of what I'm saying, and obviously I'm not a major, I don't want to sit there and say, you can write this down and, this is just my prediction, my estimate. This isn't a guarantee of rates or anything like that. But I really think we're going to continue to touch up toward that 4 on primary, but I don't know if we're going to pass it.
That's interesting you bring that up because the Fed came out earlier this week.
Yep.
And they said they don't think rates are going to push above 4 this year.
Yeah.
And it's that's interesting because they're talking about 4 possible rate increases of a quarter point. Usually when you get that rate increase, even though mortgages aren't tied to the Fed rate, it pushes them up. But what did they do yesterday?
They actually announced that, and they were supposed to make their first increase in January, and they were going to announce kind of what to expect. And they said, hey, we're going to hold off. We're not going to do anything till March. And the irony of this, right, is they took no action. And what happened? Rates bumped up.
Rates bumped up.
It's so funny the marketplace that we're in right now and kind of what we're happening is there's a lot of, I think, what you're seeing on, and this is why I say we might not cross that 4 barrier. I think it's a psychological barrier that I think that even at the feds and the government and everything else, they know that there's a psychological barrier there because we've been below it for so long, right?
Yep.
So I think they're worried about that. And they're going to make sure that they take the measures to try to keep it there. And if we cross it, I feel like we'll bounce back under it pretty quickly. But what I think we're also seeing here is that right now we've seen rates jump the way they have because a lot of lenders like myself, on our side of the table, the people that are much smarter than me that are hedging bets, figuring out where these big, national companies, you got, your United Wholesale Mortgage, Rocket Mortgage, Wells Fargo, all these big companies that are doing mortgages, and they've got people and a team of people that are determining their pricing. I think what they're kind of doing is they're hedging a little bit right now. They're like, all right, we're gonna protect ourselves a little bit. Everybody else is protecting themselves right now. We're gonna protect ourselves a little bit, right? Because they don't know where it's gonna go. And at some point, once it starts to stabilize, they're gonna be like, okay, this isn't as bad. All right, we didn't go as fast as we want. And you may see that improvement. And that's why I think we're going to see that. We'll see ourselves continue to climb. But I think as we hit that 4, it'll be like, okay, maybe we're not going to go as bad. Because right now they're saying, hey, let's hedge our bets up front to see what happens. And then once they've seen what's happened, they'll adjust to the market.
That's true. Because I bought my home in 2018. And they had actually bumped above 4. And the market slowed down a lot. So all of a sudden I had opportunities. It was a pretty good market back then too. But all of a sudden I had an opportunity to negotiate deals that I didn't see before, you know? And I think the Fed knows, hey, one of the big big power parts of the economic engine right now that's keeping us afloat, keeping us out of recession, is housing. If housing goes, boom, is the rest of the economy is going to pull back. I mean, the great thing is you look at housing starts, there's actually more new houses being built now since I think it was 2006, something like that. There's more new housing starts. And, you read through the Orlando Business Journal, you see where, Pulte's building a new one out towards Mount Dora. MI Homes is building a new one out towards Mount Dora. But we're built out. We're really kind of built out in Orange and Seminole County, especially Seminole County. I mean, they're finding maybe a 5-acre lot where they can throw 10 homes on. But otherwise, we're just spreading out and out and out. Yeah. And it's, probably half of my buyers are out of state relocating too. So we're still getting that influx of people moving in here, and and as long as that continues to happen, we're going to have that shortage. But it's great to know that, hey, you can't sit on your decisions. A lot of buyers get nervous, and the hardest part for me is their level of expectation. When I explain to them, this unfortunately is what a $300,000 house looks like right now in Florida. A lot of them need updating. A lot of them just aren't top condition. And you're trying to explain to them, I would love to find you that new home, but I can't touch a new build for under $400,000 either. So it gets very frustrating. And my poor clients in that $200,000 to $250,000 range, boy, you want to talk about finding a needle in a haystack.
Yeah, that's where the home affordability is kind of really, it's changed and adjusted, right? And I know this is a big talking point nationally, and a lot of politicians are talking about home affordability, and that's why they put the recent changes on second homes or on adjustments for rates that we're going to see go into effect more, to where it used to be a second home was essentially the same rate as a primary purchase, but that's going to go away. We're not going to like now second home is going to cost more in monthly payment because that rate's going to be much higher than a primary, which is going to help in some areas. But I think what you pointed out here is, the demand in Florida is so high and so great right now that Florida, I kind of equate back when kind of after the last, the last economic, downfall that we had, so to speak, or the hardship from the housing collapse before. And then you saw California just explode out of it. Like everybody was moving in, and the rest of the market was kind of just doing its thing, not really doing much. But then California was like going up, going up, going up. That's what I see in Florida right now. I kind of compare Florida right now to kind of that California marketplace from the early, that 2010 to 2014 range, where it just kept going. And that's because, we have less restrictions on COVID. We have the better, we have great weather. We have a lot of businesses going here. A lot of companies are allowing remote employment. We have the attractions that are open. So you've just got such a high influx of people going here that we're going to see those. So I think, even though rates are rising, and usually when rates rises, that sometimes stabilizes and gets a little extra inventory, slows down how quickly. But I don't think we're going to see that the way that maybe other parts of the country will.
No, we're not seeing it right now. It's not going up. That's what I thought. It's like, okay, hopefully December, slows down, holiday stuff like that. Inventory will increase a little bit. It actually went down. Inventory was down 50%, 2021 December to 2020 December.
Wow.
That's, less homes, higher interest rates, just makes it a very tough market for home buyers. You got to be on your game, and you've got, I got to tell you got to stay in touch with your agent and with your lender. Because if you're sitting at that high DTI where you're right there, and all of a sudden it jumps a quarter of a point and you're under contract and you're not locked in, you may be losing that house.
Yeah. You absolutely hit it. It's so crucial to be in constant communication with your lender and your realtor, because they're going to help guide you through this. And you need to be making those phone calls as a client, be talking to them. But your lender and realtor should be reaching out, having these conversations with you as well. So if you're not experiencing that, you got to call them and figure out what's going on and make sure you're still qualified. And I think the biggest thing that I took, and I know that, that from our just quick conversation here, is this isn't a doom and gloom type of conversation. This is hey, this is where we are and this is the market, right? Mm-hmm. It basically means like, hey, you can't wait if you're looking to buy, because A, it's going to cost you more money in your monthly payment, but B, it's going to cost you more money in the opportunities for the homes because values are going up. So had you bought, and let's just sit there and say, had you bought a year ago, you would have already seen, A, you would have had a lower interest rate, and B, you would have already seen 10, 15, 20% in appreciation.
I got this one for you. What do you think was the highest percentage increase in Orange County as far as jump in home values?
In home values, like year over year?
Year over year.
I would say Orange County, I don't know, what, 15%?
Windermere zip code.
Okay.
92%.
For average home sale, went up.
They went from $525,000 to over $1 million.
Wow.
92. That's in the Orlando Business Journal this week.
Wow.
I about fell over.
Wow.
Many of the other zip codes in Orange County there's I think 10 of them that were over a 30% increase in value.
Wow.
Think about that. If you had bought last year.
Yeah. So in 1 year time, potentially.
Wow. Yep.
And that's just, you know what that's doing, like the appraisals now, like that value, because those are now comps.
Yeah.
Like those are now comparable sales that are being compared to help value your property. So if you're buying right now, those sales, like you didn't benefit from that. Yep. You bought before. So what's going to happen? More people are continuing to move here. Like rates went up and it didn't slow down demand. So values are going to continue to rise, I think.
Yes.
And obviously I'm not an expert. I'm not like, you can't take this and, but it's like, this is just looking at what's happened and where we are or where we're trending. And if the same thing's happening right now that happened a year ago and a year before that, like likelihood is we're going to see a similar outcome.
Yeah. Yep. But that's where the market is today. And we do our best, we get up and do our best for our clients every day and try and keep them informed.
Awesome.
So, well, I appreciate your time this morning. I hope that was helpful information to everybody. And hopefully we'll see you again next Thursday. Take care.
Awesome. Rocky, guys.
Have a great one, man. Bye.